Let's go straight now to Bloomberg Surveillance, where Pimco's Bill Gross is speaking with Tom Keene and Carol Massar on the latest jobs data.
By riding the wave and then trying to anticipate when to get off. I mean, there's a certain point in terms of yield levels where it no longer makes sense. For instance, the 2-year at the moment at 0.35%, barely above an overnight rate that we can capture at 0.20 or 0.25, or even with LIBOR at 0.39. And so, when 2-year yields and 3-year yields move down, at some point there becomes an exit into what we call safe spread types of alternatives, and that would be, yes, an emerging or even in emerging currencies that provide a higher return on your cash deposits.
We welcome all from Bloomberg Television Worldwide and Betty Lou. My colleague today, Carol Massar. Carol, jump in here.
Bill, you just talked about those levels. Do you think we get to that point where it isn't attractive at all for you guys? It seems awfully close.
Well, we've already gotten there, as I've implied, in the 2-year area and maybe even the 3-year area. I mean, when you buy a 2-year Treasury, historically you give up you earn what is historically called a term premium, and that would be reflective of the volatility of that instrument versus Treasury bills. And at the moment, that term premium, or historically at least, has been about 25 basis points, which means that if you buy a 2-year, basically you're buying something after its option-adjusted yield that provides that 0.10% yield, in other words, less than money markets. So, 2, 3s, and 4s are reaching that point. And on the other side, 30 years are reflecting the potential impact of inflationary policies from QE2, and they're widening out. So what an investor wants to do, I think, if you're buying treasuries, is to buy the middle, to buy 5s, 6s, and 7s.
And gold here off the jobs report reverses up $9 now, $13.44. Bill, I talked to Alan Greenspan last night, and he made the sharp distinction of a benefit of QE to the financial system, but it won't come over to the real economy. Can there be a benefit to the real American economy from quantitative easing?
Well, I think there can. Alan Greenspan's an advisor to us, and we discussed the same concept with him.
But stop there. There's extremely important. He and Mohamed El-Erian are not on speaking terms because Mohamed likes the Washington Nationals. Alan likes the New York Mets. He's rooting for the New York Yankees, and Mohamed won't speak to him.
And that would be correct. Mohamed takes the sport seriously, and so does Alan. But in any case, the Greenspan thesis, as outlined in op-eds this week and at other times, is basically a trickle-down wealth effect. And yes, it's worked before, and hopefully it'll work again. That's what the Fed is trying to do. They're trying to stimulate inflation, yes, but also in the process to boost asset prices that are sensitive to inflation. And we're talking about stocks for the most part. To the extent that you generate wealth there, it trickles down and provides some type of push or animal spirits to the private economy. That's the hope. I think we're to the point, Tom, we're at a critical moment here. And sort of it's the second time in 2.5 years when capitalism, as we've known it, is under relative siege. And if quantitative easing 2 can't reflate capital markets, then it'll be a long slog back to prosperity, I think. And perhaps
okay, well, that is some dire predictions coming out from Pimco's Bill Gross on Bloomberg Surveillance, saying that basically we are now yet again at a crisis point here. And if we don't do something about that, we're going to see a long slug ahead for the economy.